Welcome to the Innovators and Investors podcast. I'm Kristian Marquez, founder and CEO of Finstrat Management. At Finstrat, we provide CFO-led accounting, finance, and reporting services to assist clients monetize their business. Stick around to the end of the podcast, and I'll share how you can be our next guest. Now, on to the show. Hello, and welcome to another episode of the Innovators and Investors podcast. I'm your host, Kristian Marquez, founder and CEO of Finstrat Management. Super excited to have with us today Dan Rizzo, who heads up his family office. Dan, welcome to the podcast.
Hi, thanks, Kristian. Great to be here.
So, super excited today for our audience benefit. Our guests have predominantly been entrepreneurs or investors, but you're both had a material hand in taking an early stage company to a multi-billion IPO. And today you invest on behalf of your family office. So to kick things off, if we can start with your experience as an entrepreneur and how it influenced your investing, I think it's a great place to start.
Sure, yeah, happy to. Experience as an entrepreneur was, I would say, abnormal. We didn't start a company with a grand vision in mind. We're a consulting firm, a management consulting firm helping other businesses. And over the course of many years doing that, would say to ourselves, one of these days, we're going to find an idea and we should just put all of our attention into that. And made the ultimate pivot out of management consulting into what we saw as an incredible vision for what healthcare, what data could do in healthcare. Back before data was really even digital, it was very much in paper at the doctor's office, and found a path, found customers, and we were off and running and focused on that pivot. And through strokes of luck and hard work, made it into a business I'm pretty proud of.
And so for the audience's benefit, what was the approximate time frame that you started the consulting and then you started to wrap things up into healthcare IT?
Yeah, that consulting work was going on in the early 2000s, call it 2000 to 2005. And it was in late 2005 where we saw an opportunity to make a pivot and started figuring out how to be a software and services company and help our health insurance plan clients use data to improve care and financial performance.
Company eventually resembles a traditional software as a service or SaaS company, but you made reference to starting off as providing management consulting. My perspective, that's really unique. I think it's unique because a lot of SaaS companies today struggle to at least break even. Whereas if you have revenue, presumably profit coming from your consulting services, it gives you perhaps a bit more time to find a solution. And so I'd love to hear your perspective, how that influenced the timing and the path that the company eventually took.
Yeah, it's interesting. When we were thinking about how to help our clients be successful, what we really thought about was that we were really early in that software as a service, using data to improve the operations and performance of a company. And we found that our clients, in many cases, wouldn't understand or know how to operationalize or implement what we would tell them, the insights we would bring to them. So we found that we needed to bring a service component because we knew exactly how we could use the information that we garnered through this vast array of data to achieve their goals. And that's really what drove a lot of our work over the course of the early part, call it 2006 to 2014. As many companies experience, software was very high margin. But if we couldn't concretely show a return on investment because the client didn't know what to do with the data, then it didn't matter how high margin, didn't matter how little we charged for that software if we couldn't make it show an ROI. So that really drove our services side of our business. As you'd expect, services are pretty low margin, but it made sure that we unlocked the value. And that really drove that decision. Over time, the customer base got more sophisticated and it became more commonplace for how to use information like what we were giving them, that they learned how to do that and took a lot of the services work in-house, allowing us to really just become a software as a service, kind of SaaS-based B2B company. Best of both worlds. They get to own the piece that they can be good at, and we get to build a business on high margin, high growth software products.
And so, at what point do you think in the journey, do you think there was a realization that no, we've actually have been in the market long enough and that we can facilitate this transition from people within the company's walls to the clients to be able to take it over?
Yeah, I think that it's in a customer base. You're going to have any industry a set of early adopters, innovators, and then fast followers, and then those laggards. And we had a number of clients that fit each of those categories. And so we started to see those companies that really were leaders, innovators, making that shift. And that is where we were able to see that we have to be able to work both ways so that we can serve the innovators as well as the fast followers and laggards and then they learn from each other. They teach over each other over time. One of our big clients or several health plans in the Blue Cross network. There's a bunch of them and they collaborate, and some of them are leaders and some of them are followers, and they teach each other. And we just saw that throughout the industry. So we had to be flexible to be able to deal with both and really serve both well over time. And that's the journey, right? Finding where you have customer needs and figuring out how to be the right fit to solve those needs. And there's a lot of things we did, some things we struggled with. One of the things we did pretty well was listen to what our clients needed and get creative about how to work with them.
And so, as the company grew, how was the decision made to grow products or create products organically versus do acquisitions?
We were in such a unique space. We never felt this was early on. I would say in the first 5 years, 7 years before IPO. We rarely encountered a company out there that was serving the same industry that we found that had a product was at a capability level at or above what we think we could bring. We got really good at our core competencies, data management, data intake, the earliest versions of artificial intelligence against that data. We didn't use those words back then, but it was precursors to that. And so you didn't find too many companies out there doing the work that we were doing or having complementary solutions. But we did find one. So pre-IPO, there was a particular leader in a particular niche, and we tried to build a product around it. And we found that we couldn't build it as well as they did. And so we pursued an acquisition, and it really unlocked a ton of value because we were able to pair their best in breed technology with what we were excellent at. And it was certainly a scenario of a 1 + 1 = more than 2. After being public, having a public currency to make acquisitions, then we really use that to expand into other verticals in our industry, serving different client bases, but all with the same thesis of data as the core that you can harness.
And so, as you reflect on the company's acquisition strategy, anything you would have done different?
Boy, it's as you might expect when you move into a bit more of an acquisitive mode. You look at a lot of deals and you turn a lot down, right? It's easy to say no to a deal. It's easy to find a reason not to do some things. Yeah, it's as you grow bigger, like we were doing, and dare I say more bureaucratic. It only took that one person in the room, the skeptic, to really influence those things. So there might have been some deals that we didn't do that I think could have been really interesting for us. At the end of the day, it's hard to say what those would have turned into and how it would have worked. But what we ended up doing and acquiring in our healthcare data world really worked out well for us. There's a few shots we didn't take that I kind of regret, but I can't complain too much. I think it worked out pretty well.
Fantastic. And so whether the growth is organic or being contributed by acquisitions, you're still having to manage implementing scalable infrastructure while also remaining profitable. Curious as to how the company's philosophy played out with respect to building in-house resources versus outsourcing different functions.
Yeah, I would say that when we looked at an acquisition, we really focused on revenue synergies and how it would accelerate growth, either of products that we had in market or products they had in market through some combination. We didn't get too hung up on cost synergies. Now, yeah, so it was never a scenario of justifying an acquisition because of what we could save through redundancy eliminations. Yeah, and we never really did an acquisition because we thought a client or a company had some internal capability. An internal capability might be some excellent capability or staffing in software development, just making that up. As it turns out, sometimes we serendipitously found that there were people or groups inside companies that we acquired that when we saw their counterparts in the core business, that they were better than our core business counterparts, and took advantage of that, right? Brought those groups together. We never intended on buying, building, and spinning something out. So we really did integrate our acquisitions into our core business quickly, and on occasion did find that there were capabilities that we didn't expect in an acquisition, and would have been foolish to not take advantage of that.
Yeah, it's interesting. A lot of, especially for early stage companies who are very cost conscious, deciding what's a core competency and whether you're going to keep it in-house or not, obviously has a big impact on the business. But especially as you grow, if you have the flexibility of picking and choosing, I imagine it's just a tremendous asset.
Absolutely. Yeah. Yeah.
And before we wrap up and transition over to your experience investing on behalf of your family office, I'd love to hear what the experience was like taking the company public.
Yeah, the process of going public was fascinating. I would say that for entrepreneurs that are thinking about that path, you inevitably start to do the work to hire people to help you, hiring the right accountants, hiring the right lawyers for the transaction, and SEC hiring investment bankers. They put you on a track, and it's hard to stop that train rolling. So you might hire people and say, we're investigating an IPO, or we might do a dual track, we might go into an acquisition process. All those people, they want you to do that transaction, that IPO, and that when that train's running down the track, it is hard to turn it off. Now, for us, that ended up being a very good thing. And as well, we did look at a dual track option. The multiples that we were seeing in the market at the time were really appealing. But once that train's running down the track, you're going public. It's just a matter of time, market conditions, that kind of just timing considerations. Of course, if something blows up in your core business, that's an issue too, but that didn't happen for us. Once you're in it, though, we had a great time in our S1 explaining the business to our bankers, testing the waters with investors to understand their receptivity to a company like us in the market. And then once you're there, doing the roadshow is exciting and exhausting. Yeah, you're just having so many meetings every day in New York, Boston, San Francisco, Midwest, Chicago, Milwaukee. You're all over the country for 2 weeks. Of course, this was all pre-COVID. Nowadays, there's probably a lot more Zoom going on, but it was a blast, and I wouldn't have traded it for the world. Going through that process.
Fantastic. So tremendous amount of experience now from early days to IPO, unique as far as entrepreneurs go. I have to imagine this has absolutely influenced how you invest. And I should mention for our audience, you also happen to be a CFA charter holder, must be over 2 decades by now. So you're also arguably a professional investor, in so much as we can say it's the pinnacle of professional certification in the space. Would love to hear how you think about looking at companies before you invest.
Sure. Yeah. In the FA exam process, you do a lot of math, and you learn a lot of formulas and techniques. What you don't learn is how to evaluate the character of a CEO and management team. You don't learn like the secret sauce of what it takes to run or build a company. So there was a lot of learning as I started investing, about that, how to make sure that the team I was backing was a capable team that could deal with the highs and lows, ups and downs, and challenges of a startup and taking a early stage company to the next level. That was a fascinating learning curve. I have the scars to remind me I've learned. I also have the scars to remind me that one of the most important things that I did as an entrepreneur was solve problems and not get discouraged. Find ways to get things done, find ways to win. And that optimism doesn't always serve you well as an investor. I often look at an entrepreneur and think, I can see 4 or 5 different paths that he can solve this problem with and move forward with. So my optimism about the ability to solve a problem or move forward on an issue didn't always come out the way I hoped. So I really had to figure out how to temper that optimism or be more skeptical, as where there are paths that I see, that doesn't mean that those paths are going to be executable to the investor, to the entrepreneur I'm investing in. So learning a lot of lessons, still learning them. Find that investing in my family office, I'm much better at picking other investors, i.e. private equity teams, venture teams, than I am at directly picking entrepreneurs. So I tend to do more of that anymore than I do directly backing entrepreneurs.
Okay. And so then would love to hear your perspective then, and when you're looking at professional investors, what's a common profile that you see in the investing team?
When I look at, let's say, venture, because once you get to private equity, the level and in growth stage, that level of sophistication, you have a pretty solid team. But what I see in a lot of early stage seed type managers or venture managers, I see a lot of entrepreneurs that think they can become investors. And it's easy to presume that because they've been an entrepreneur, they know how to do it. And that I definitely have found isn't the case. So in those type of managers, really look at track record. I'm rarely going to do something in a first fund for one of those. But when I see a track record that you show me, you've translated your capability of being an entrepreneur into being an investor, then I love you, because then I know that you can help entrepreneurs in a way that an investor who's never been through it can't. And so I really look for that. And then I'm always reminded by the fact that one of the hardest parts of being an entrepreneur is dealing with your team and staff and the normal human dynamics of leading a team and having employees. And I see a lot of early stage managers go from solo practice type managers where they're doing it all themselves to wanting to grow and build out a team. And they don't always appreciate just how much of a struggle that is when you go from yourself to now having a team and the distraction that comes with that. And so I look a lot at that, how a manager is growing his team, the capabilities of the team. I like to talk to other people on the team to understand how they function and ensure that they really can go from what often you see as a small fund of a solo manager to a much bigger fund, and not lose the secret sauce of it, not be distracted by the fact that they now have to have a team, managing a team, to take away from the attention they put on their investing previously.
Curious to know, how often do you meet the team in person before making a decision to invest?
Probably the vast majority of times. I'm meeting not just the lead, but a broader set of the team. And Zoom's unlocked a lot of that, but it was at that early stage, that seed stage and early venture. I think that's really important. Once you get past that to bigger stage, I think you can look more at track record. You can do more with reference checks of portfolio companies, reference checks of other investors. Like anybody, when you're hiring somebody, there's just the appropriate amount of diligence. And so it depends on what job you're hiring them to do, depending on how much diligence you want to do.
It makes total sense. Building on that, we've had guests on the podcast, as well as in conversations I've had with limited partners who feel that they won't invest with a professional investor unless they've been an operator. So I'm curious to know your opinion on the flip side of how important it is for you that the investor actually knows what it takes to scale a company.
Yeah, I think you have to pair strategy with capabilities. So if I'm talking to a manager that is going to be very active, in their portfolio companies, sit on boards, coach management teams through key growth areas like hiring sales teams, going to market, building go-to-market motions, hiring technology teams and managing them. When I see venture managers or early stage seed managers having a strategy that's very active, boy, they better have had that experience. But that's not every investor. There are many early stage investors, venture and up, that are more stock pickers. They're not trying to sit on boards. Now, they might in their fund have 30, 40 investments instead of the one that tries to get really active, who might have 7 to 10. Different strategies, different ways to approach it. And if the strategy was mismatched with the capability, I think that'd be a real problem. So that's something I look at.
Dan, great conversation, tremendous amount of insights. Before we wrap up, what advice would you give to not only entrepreneurs out there who have their sights set on the brass ring, but also other heads of family offices who are looking to navigate a whole host of different investment options that are out there?
Yeah, boy, books have been written on both those questions. So I doubt that I would give much more insight, except to come back to, on the founder side, don't be afraid to pivot, right? When you see an opportunity that maybe is a little off core, if it's the right opportunity, pivot. Yeah, I certainly would never be where we're at if we didn't. Yeah, from an investor perspective, I think it really just depends on where your capabilities are and where you want to go, right? Like I said, when my CFA hat on, I was very much more stock picker type, analyzer, could sit and do a lot of math. I had to really learn a lot about how to pick the right teams that I was going to back. And so that's still a learning process. And like anything, if you recognize where your strengths, weaknesses are and try to eliminate those blind spots, I think you can be really good. And no matter how you work, how you advance your mission there. But yeah, if you don't know your blind spots, get into some, you'll have the scars like me. So.
Yeah, it's interesting. I have met a handful of founders who find it difficult to pivot. And my sense is a lot of times it forces them to confront their ego that they were wrong.
Mm-hmm. Oh, for sure. Yeah.
Yeah. And probably just core characteristic is that you have to be a bit brazen, but at the same time, be able to admit, hey, I don't know everything. Mm-hmm. I don't know anybody who does.
Right.
But yeah, and 100%, I think great insight on the investing front. Consistently hear time and again the significance of the team, whether it's the actual boots in the trenches or someone who's making a decision of where to deploy capital. Yeah, it's really difficult to quantify, but it seems to be absolutely essential. I rarely come across a product that can run completely on its own.
Yeah. Yeah. No, exactly.
Dan,
yeah. Good. No, I've enjoyed the conversation. Yeah. We're all still learning a lot. I hope that maybe somebody can find a little nugget in here that can help them.
100% agreed. I think this was a great podcast, and I think there are a lot of nuggets in here. And with that, Dan, thank you so much. Appreciate your time. And this is another episode of the Innovators and Investors podcast. Dan Rizzo, folks.
Thanks, Kristian.
Kristian Marquez here. Thank you so much for listening to the Innovators and Investors podcast. If you're a successful founder or an investor, would like to be on the podcast, please visit podcast.finstratmgmt.com/podcast-guest. If you've got something out of this interview, please share this episode on social media. If you know someone that would be a great guest, please tag them on social media to let them know about the show and include the hashtag Innovators and Investors. I'd love to see your posts and suggestions. We're regularly putting out new episodes and content. To make sure you catch each new episode, please subscribe to the Innovators and Investors podcast. And your thumbs up, ratings, and reviews go a long way to help promote the show, and it means a lot to me and my team. Would you like to know more? Go to our website, finstratmgmt.com, or follow us on LinkedIn or on X. Our handle is @finstratmgmt. This is Kristian Marquez. Thank you for listening. Until next time.